Welcome to By the Books, the podcast helping business owners navigate the complex world of business, tax, and bookkeeping. Now, to the owner and president of Sakline, Lindsay Kline.
Hi, everyone. Thanks for joining us today at By the Books. I am Lindsay Kline with Sakline, honest, accurate bookkeeping performed on time. And I'm here today with Kris Gross of Friedo Nation. Thank you for joining me today.
Thanks for having me, Lindsay.
So I have an interesting topic today.
Okay.
This is about a question that every CPA answers differently. So here's what happened. This is how this whole thing started. I went to a CPA study group the other day, and this is a group of maybe 100 plus CPAs that gather for lunch. People submit questions before coming to the lunch about issues that they're groveling with, something they want to get some other points of view on, best practices, just kind of trying to figure out the best way to handle it. Most of the questions that come up during the lunch are pretty well answered within a few seconds. People come to a consensus, everyone kind of nods their head and we move on, kind of thing. There might be a little bit of discussion, but by and large, we get through questions pretty quickly. Well, at the last meeting, there was this question that spurred a lot of, I wouldn't even say debate, a lot, it got kind of quiet and everyone's kind of like, pondering and, that's interesting, kind of looking at each other. And then, someone would say, well, what about, and then propose something. And then someone else, well, no, that wouldn't work because of, X, Y, Z.
Yeah.
And we weren't getting to that consensus place where everyone's nodding and going, yeah. So, everyone would, kind of propose a little something and then, no, that wouldn't work because of this. And there was all this kind of back and forth. And we never really came to this is the answer.
Right. Which
really fascinated me. I'm not a CPA, right? I'm coming in there as a bookkeeper. I'm trying to learn, get around the professionals, so I'm watching all of this play out and going, wow, this is really interesting. And I really didn't fully understand the question even at that point. But I'm like, all right, I want to study this and figure out why this is stumping so many people. And there's a lot of experience in the room. I mean, 100 CPAs, some of them have been in the, tax industry for 30 plus years. Why is this something that they're having difficulty figuring out? So it just so happened I was headed to San Antonio after that, which, by the way, we now have our San Antonio office open. So I was headed to San Antonio, and I'm trying to get a network of CPAs down there as well for our clients. Since we don't do taxes, we only do bookkeeping. So I like to have local people that as we get clients, we can refer people if needed. So I had several meetings set up with CPAs down in San Antonio after that. And I thought, you know what? I'm gonna ask this question and see what happens. And I probably met with maybe 10 CPAs while I was down there. And I asked every single one of them this question, and every single one gave me a different answer, which just fascinated me even more. This is really interesting. No two CPAs I've talked to have given me the same response and the same solution. So this is why I thought this would be a great podcast episode.
Yes.
I don't know what to call this yet. The tax question that rocked the CPA world or something.
That's interesting. Yeah.
So the overlying, I guess, thing that has caused me to kind of sit back and go, wow, is really hitting home the fact that so much of what our tax professionals do, a lot of it is up for interpretation. And a lot of it is based on their risk tolerance, their personality. And I've seen so much of that come into play by asking different professionals the same question and see how they bring in those other factors into how they would respond to this situation. So I'll break it down a little bit and then kind of tell you what the CPA solutions were.
Okay.
And it's a little bit complicated, so I'm going to kind of try to break it down where hopefully anyone, including someone as yourself that doesn't have a tax background, can understand. So this specifically relates to S corporations or LLCs that are taxed as an S corporation. There's this thing called stock basis. Any shareholder of an S corporation has stock basis in the company. It's similar to what we know as equity, which I've talked about on the show before. You know, equity in a company is similar to like equity in a mortgage, right? You have the liability, your mortgage, and you have the asset, the house, right? And as you pay down your liability, you're gaining equity in that house. Same thing can happen in a business. So stock basis is very similar to equity, but there are some things that will alter your stock basis that would not alter your equity. So there are some differences to it. And for tax purposes, the stock basis is not supposed to go below zero. So it's almost like a bank account. If it does go below zero, then the IRS sees that as a taxable event where you should be taxed on the amount that it goes below zero. So if you think of it like equity, if you're the owner of a company, an S-corp specifically, and you're taking distributions, right? So you're pulling money out of your company. The IRS will let you do that without being taxed on those distributions up to the point that you get to that zero mark.
Okay, gotcha.
When you go below zero and you're now basically out of that equity, that's that stock basis. Now the IRS says, no, that's a taxable event now. Now you need to be taxed on those distributions. Now, the problem, and this is where this question comes into play, sometimes you can go negative on your stock basis without taking distributions. You can actually create a taxable event without having pulled any money out. And that was the situation that came up with this question. So this question that this one CPA proposed to, or gave to the group, presented to the group, was a dental practice. It was one owner. He was an LLC, and he was being taxed as a sole proprietor. He bought a bunch of equipment, $600 and something thousand worth of equipment. He took accelerated depreciation on that equipment, which means, and the IRS will let you do this, whenever you first buy a big purchase, you can take a lot of the expense in the first year or two, which is what he did. So he got a lot of write-offs, right? His taxes look great because he was able to take a lot of deductions on that equipment. Well, the following year, his accountant took the s-corp election, meaning that he now wanted to be taxed as an s-corp instead of a sole proprietor, which you can do when you own an LLC. The problem is when you switch to an s-corp, now that tax basis comes into play. It doesn't come into play when you're a sole proprietor. It doesn't matter. But when you're an S-corp, it does. All of a sudden, you've got to be concerned with what your stock basis is. So he switches from sole proprietor to an S-corp, and all of a sudden, he's already at the very beginning at a negative stock basis because he has this huge liability that he took with the bank when he bought this equipment. So he's got $600 and something thousand of liability. But because he accelerated his depreciation and took a bunch of that expense up front, his asset value was much lower, like $200 and something. So we're dealing with a $450,000 difference where he has now gone below zero on his stock basis. Does this make sense?
Yes.
Are you following?
So let me see if I can, this is the way I'm kind of looking at it is, once you get to that point where your liabilities are exceeding the assets, that difference is where you're kind of below this zero line. Is that how to think about it?
So think of like when this happens often when you buy a car, right? Oftentimes a house, it will appreciate in value. So you don't get this as often with a house purchase. But if you think about buying a car, as soon as you drive that car off the lot.
Yes, price goes down.
It's a depreciating asset, right? It's immediately worth less than when you purchased it, right? So oftentimes with a car, your liabilities are more than the value of that car, right?
Yep.
If you think of it that way. And so this is all taxes, right? It's all done on paper. The depreciating aspect of this is all done because of taxes. It doesn't have anything to do with the fair market value of that equipment.
Gotcha. Okay.
That equipment might still be worth close to $600,000, but on the books for tax purposes, they have depreciated it down to 200 and something. So as a result, you have that situation like you have this car that, let's say you got in a car crash, right? Then it really depreciates, right?
Yeah.
Let's say someone bashed the side of your car in and you've got this huge dent now. This car is worth much less than the car note that you have on that, the loan. So it's that kind of situation. And because the IRS gives you stock basis in some things like contributing assets, but it doesn't give you stock basis for that loan that you have. That loan is a company loan. So the shareholder is not getting any stock basis for that loan, even if they're personally guaranteeing the loan. So that's what creates this situation where now going into this S-corp, he's already $400,000 in the hole.
Yeah. Yeah.
So the question is what is the proper way to handle this? Because if nothing's done about it, the IRS would say that $400,000 is taxable.
Wow.
Now, can you imagine me as the client? And by the way, I had one CPA. That was his solution. He said, there's no way around it. You have to pay taxes on that $400,000. So you can see now this is a huge material amount of money that we're dealing with here, that if that's the solution, it causes a huge tax liability. Depending on what tax bracket you're in, that's going to be a huge amount of money. So you can see this is what's at stake.
Yeah, there's a lot riding on this question.
Right. There's a lot riding on this question. There's potential for this business owner to have to pay thousands of dollars in taxes. So let's say you have this problem, right? And as a business owner, that probably doesn't have any background in taxes, probably didn't even understand that when you switched over to an S-corp, all of a sudden you're creating this problem, right?
Yeah.
His CPA probably never told him that. Maybe his CPA didn't even think about that issue, right? So whatever the circumstances were that led up to this moment, now he has brought the problem to this new CPA that was in the group, and maybe it was because of this problem. Who knows, right?
Yeah.
So it was very fascinating in this group. Like I said, when this question came up, everyone was like, because usually these circumstances happen because the owner's pulling distributions out. And that's kind of a no-brainer. Yeah, you pulled out the money, you owe the taxes on it, right? But in this circumstance, that wasn't the case. This was just a purchase of equipment. They took depreciation on it. So the owner didn't get to pocket any cash. Every single CPA I've talked to has given me a different solution to this. So I actually last night I wrote out all the ones I could remember. I think there's actually more than I can remember at this point. I should have been taking a list as I did it. But I already told you one of them where the CPA said there's no way around it. You have to pay the taxes on the $400,000. Another suggestion that I got from a different CPA, he said, well, just amend your prior year's tax return and change your accounting method so that you don't take the accelerated depreciation.
Okay.
So in other words, you're not going to depreciate as much, which means you're going to have to pay taxes from last year and penalties because now the IRS says, oh, wait, you owed more than what you said you did. So now we're going to charge you penalties. So there's also some tax ramifications to that solution. Another CPA said, well, just revoke your S-corp election, go back to being taxed as a sole proprietor, which there's a limitation, I think, on the time frame that you can do that. So they may already have been past it, and that may not be a solution they can do. But if they could, that CPA thought that would be the best solution. One of the problems that have been posed by other CPAs is, well, if they do that, they can't go back for another 5 years.
Okay.
So there could be tax ramifications for that because there are tax benefits to being an S-corp.
Sure.
So if you have to stay a sole proprietor for 5 years, your tax liabilities may end up being more over the course of 5 years than if you just stomach it now. So that was another solution. Then there was, well, why don't you refinance the equipment loan in the owner's personal name? So take the liability out of the business and put it into a personal loan And then essentially you're passing along that loan from the owner to the corporation. So he would get that stock basis by essentially loaning to the company.
Gotcha.
So that was another solution. Then I had one CPA tell me, "Oh, just leave it negative. I do it all the time. No problem. I do tax returns that have a negative basis all the time. No worries." And I'm like, that's interesting, because from what I understand from everyone else, that the IRS kind of sees that as a problem.
Yeah.
Oh, no.
Right.
I've done it all the time. They've never said anything. So I got that one. Then I had one that argued me, like, no, there's no basis issue here. No.
So they said there's not even a problem
There's
at
not
all.
even a problem. There's no problem here. So I got that one. And then I had a meeting with two CPAs at one time. They were both with the same firm, and they met with me. And when I posed this scenario, they both sat there in silence for about a minute, just kind of, And then they finally said, we'd have to research that. We're not sure.
Right.
So, I mean, in that case, at least they admitted they didn't really know.
Yeah.
And then the last one was just create a shareholder loan for the difference, which is another solution that I think probably is the most common solution to this, is just create a loan for the variance, for the amount that you're below zero. And as you get stock basis built up, you pay that loan down until you're back to zero. And that, if there was any kind of consensus, that is probably the solution.
Okay.
I heard more. Now, this has been challenged by the IRS, and there's actually been case studies where they've challenged it. And in a couple of the circuit courts, the courts did side with the business owner that it was okay for them to do a shareholder loan to get their tax or their stock basis to zero, but all circumstances are different in every case. So that's not to say that in, one person's particular case that would stand in court, especially if you're in a different circuit than where that case came up. So you can't always rely on that, because the details of that case may have been very different, So
here are just some of my thoughts on this. Is I think the one most prevailing thought is this is why it's important to have a good CPA.
But question, which one is the good one?
But no, what the reason I'm saying that is because, or maybe you can tell me if I'm wrong, would a good CPA have seen this problem arising when switching them from a sole proprietor to an s-corp?
Yeah, I would say that would be true, that they would probably have seen this coming.
Right. And so that's the aspect where I said the reason to have a good CPA is they catch this on the front end before you've got the problem to deal with.
I would say I would have liked to have had the professional that would have said, if you switch to an s-corp, here's the problem it creates. So, maybe we don't take accelerated depreciation this year, or maybe we wait a couple years before we do it. Give the business owner some options and explain why there could be some complications.
Yeah.
So yes, in that regard.
And then I think what else is interesting is, like you said, you can see the just based on their answers, who are your more conservative CPAs versus who are the more liberal.
Yes.
Like the guy who said, "Oh, just forget it. Like, just let it go. It's not a big deal."
Yes.
I do think it's funny that it sounds like every other CPA was like, "Oh, well, you got to do something. And so do this or do this." And then this guy just, no, like, just leave it.
Yes. That fascinated me.
Yeah.
And I think this is where I say, I think a lot of the decision-making process has to do with the CPA's risk tolerance. But here's what's interesting is the CPA's risk tolerance may not be the business owner's risk tolerance.
Right.
You know what I mean?
Yeah.
I don't think, the guy that just said, just leave it on there. I do it all the time. The IRS has never said anything. His clients may not have that high of a risk tolerance.
Yes.
And then the CPA that said, no, you just need to pay the taxes on it. Obviously, that's the most conservative you can be, is just go ahead and pay the taxes on it. Well, his clients may have more risk tolerance than that. They may say, you know what, I'd like to go ahead and try one of these other solutions so that I cannot pay those taxes. And if the IRS does come back and say I owe it, that's fine. I'm willing to take that risk.
Is there should this be a warning to just prevent yourself from the situation in the first place from making a big purchase like that and taking out a big loan? Should that scare anybody away?
No, I don't think so. I think that people just need to understand when you're switching your tax status, when you're going from being taxed as a sole proprietor to now you're being taxed as an S-corp or a C-corp, just know there are differences and there's going to be ramifications to that, whether good or bad. Usually they're good. That's why people make that election oftentimes. But just know there could be some negative consequences to think about. And hopefully you'll have a CPA or a tax professional that'll really help you understand what those are.
Right.
And this is one thing that I didn't get, which is interesting. And because it got me thinking, so far I've done my own taxes every year. I've never given up control of that to someone else. And I'm probably starting to get to the point where I need to think about doing that because it's getting complex enough. But going through this experience, I think has made me even more like, no, mine.
Yeah.
But I got to thinking, okay, what if I was to hire a CPA to do my taxes? What would it, what solution would I be wanting them to come up with?
Yes.
And I thought, what I really would like is for them to tell me, there are 8 ways that we could go about this. And they vary in the level of risk. And let me explain to you with the various ways that we can handle this, and let me decide which option we take.
Yeah.
Just make me understand what the possible ramifications are, what the possible risks are, that if I was to get audited, the IRS could potentially find this to be taxable. I could potentially get penalties, right? Help me understand the risk.
Yeah.
But at the end of the day, let me decide whether to take the risk. And that's the CPA I think I want.
Yes.
The one that doesn't think there's only one way to skin the cat, but realizes that so much of this is up for interpretation. So much of this, even when you think about it, you've got an auditor oftentimes coming to look at these situations that may honestly not even know more than your CPA does, right?
Yeah.
So
yeah.
Just because that auditor says, I find this to be a taxable event, it's not over. There is still a long, lengthy process you can go to say, no, I think we were right. This is not a taxable event. And here's some case studies to back this up. Here's some documentation to back this up. Here's some statutes to back this up. Whatever it is, just because an auditor comes in and says, I find this to be a taxable event, it's not over. And I think people don't understand that a lot of times. So, in my case, I have very high risk tolerance. Like, bring the auditor to me. Let's go. Yeah. Like, I will do research until I'm blue in the face to prove my point, right? So it doesn't scare me if an auditor were to come in and we're having to defend our point of view. So my risk tolerance is very high. So I probably need a CPA that's willing to go there with me to say, all right, well, if we get into an audit situation, let's go hand in hand and let's take this on. I actually probably would relish the opportunity. So, to me, it'd be a learning experience, but I'm up for the fight. But there's other business owners that are like, oh no.
Yeah.
I will pay more tax if I have, overpay tax if I have to keep them away from me.
Yeah. Yeah. No, see, I don't know if I'd go as far as saying, okay, yeah, I'm just going to pay the taxes on the $400,000, right? But I am the guy who, when you get done with TurboTax and, and your audit level's just barely in the yellow, I'm the one who starts sweating a little bit. And I'm like, do I need to buy the audit insurance? So that's the kind of person I am. Here's what me coming from just learning everything about this situation as the podcast has gone on. This is what seemed to me like what I would do. And obviously someone smarter could talk me into something different. I think I might lean with, let's just switch back to being a sole proprietor. We get this taken care of. And then if it's 5 years, we can make the switch then. So what would be the reason I wouldn't want to make that decision?
Well, oftentimes the reason people make the election from a sole proprietor to being taxed as a sole proprietor to being taxed as an S-corp is because there are tax advantages to doing that. One of the biggest ones is when you're a sole proprietor, whatever your profit in the company is, you're paying payroll tax on all of it. It's called self-employment tax. So, the things that you see, most people see it coming out of their paycheck, right? Medicare and Social Security, all that stuff that comes out of your paycheck. If you're a sole proprietor, you're paying that tax on all your profit. If you switch over to be an s-corp, now you pay yourself a salary instead, and you're only having to pay the payroll tax on your salary. And the IRS says you have to do a reasonable salary. You can't pay yourself $12 a week, So, and people have gotten in trouble for that, right? Because they just pay themselves a minuscule amount, and then they take huge distributions. Because you can take distributions, as we talked about, and not be taxed on those distributions. But if you're not paying yourself a decent salary and you're taking huge distributions that are non-taxable, the IRS may come knocking, and in fact, we have a podcast episode talking about that where I give some case studies where people had gotten in trouble because they took a small salary, took huge distributions, and the IRS came back and said, no, those distributions are taxable.
Those are the Lindsay Klines who have a much bigger risk tolerance than I do.
So that's why most people make that switch, is because they can lower their tax liability in the long run. And that's why you have to take that into consideration. If you can't switch back to being an S-corp for 5 years, over 5 years, are you going to end up paying more in taxes than you would just paying it on the $400,000? I mean, there's a lot of variables that go into that situation to making that decision.
So what have you learned from this situation? And maybe it takes more looking into this, but what's your big takeaway?
I think I always knew that there was a lot up for interpretation, but this really hit that home.
Yeah.
Like how much is up for interpretation, and how for one problem, there can be so many different ways to solve that. And that different tax professionals, like I said, it kind of depends on their risk tolerance. It depends on their background, right? What experiences they've had. Maybe there's been a tax professional that's gone through an audit with this very specific issue, and, maybe they got burned by it. And so that's kind of altered the way that they handle the situation. You don't know where they're coming from or how they got to that place, but almost every single one thought their way was the way.
Yeah.
And so, like I said, I'm still waiting for the CPA. I'm going to keep asking, right? I'm going to keep this experiment, and maybe I'll switch questions eventually. But I'm looking for that CPA that says, you know what? There are 12 ways to skin this cat.
Yeah.
You decide. Here's the risk. Here's the risk level to each one. Here are the possible ramifications. Which direction do you want to go? That's the one I want to find.
Yeah. So I think I will close my big thoughts with this. And tell me if I'm wrong. It seems like if you face an audit situation, an auditor comes, it's not like he comes and he tells you, okay, well, what's been presented to you is 2 + 2, and your answer has to be 4. And if your answer is anything other than 4, you're in trouble. It seems like it's much more of, hey, this is why I think you're wrong, but if you can provide reasonable explanation. Hey, look, this is the reason why I did it. I found this case here. I found my research here. Hey, maybe I called, the IRS. I talked to so-and-so on this day, and they said I could do this. It seems like it's much more of, if you can reasonably defend your position, then there's not necessarily one right way to do everything.
That's absolutely right. And I don't think people realize that by and large. Because think about it, if it's up for interpretation with a group of 100 CPAs, is it not also up for interpretation for that auditor? Yeah. No, you're right. And think about it. If you have a spectrum of conservative to risk on tax professionals, do you not have the same when it comes to auditors? So you have the ones that probably are sticklers that take the most conservative viewpoint, all the way to the ones that are, like the guy who's like, just leave it. The IRS doesn't care. And maybe he had an auditor where the auditor didn't care. So not only that, but you got a variance in knowledge. How much knowledge does that auditor have about that specific issue? A lot of times the ones, the auditors that come, the field auditors that come to your office and spend weeks in your office, sometimes they are CPAs, but not always. Right. My grandmother was an auditor. She was not a CPA. And it was very interesting because as my knowledge of tax grew and bookkeeping and all of that, as I was a teenager and young adult, I started thinking, oh, she'd be a great resource to kind of pick her brain.
Yeah.
But oftentimes I would, present something like this, right? Because I'm curious cat. If I latch onto something like this, or I'm like, oh, this is very interesting, I'll start asking everyone about it. So she'd be one person I'd talk to, and she'd just kind of look at me and go, oh, that's interesting. I didn't know that. I thought, and you're going and auditing people and telling them how they're it was very eye-opening for me, having someone I personally knew and realizing, wait, my knowledge level seems to have exceeded yours, and yet you're the one going in and telling people what they owe.
Yeah.
It's very interesting. So yeah, that's one thing that, especially since my risk tolerance is high, I don't fear those audits because I know this person coming in, and actually one of the CPAs I talked to, they were talking about going through audits. They said, we just dump as much documentation at that case studies, documents, statements. We just flood that auditor with all kinds of paperwork.
Right. If you're going to bug me, I'm going to make you read everything to know why I did the thing I did. Yeah.
So that's the strategy they take, is just to overwhelm them with, just anything, any fact they can throw at them, any case study they can throw at them. And they have found it to be a very effective strategy. So anyway, I thought this was interesting enough to make an episode out of. What do you think?
I think it's fascinating because I had never, and this is me maybe just being more on the outside looking in, I had not considered that you could go to 5 different CPAs in a row and they could all give you a different answer on something because they're, as you have brought up, their risk tolerance is all different. You know, the first guy you may go to may be the most conservative. And his thing is, hey, we are going to do everything. I don't want to see an auditor ever. Yeah. And then the next guy you may go to says, oh, I want the auditor to come here. And I am so excited to show him why he's wrong. Yes. And I had just, I had never considered that. I just kind of considered, here's your group of tax professionals. They'll all agree on the same thing. They all think on the same thing. Nope. So it's opened my mind to, in the world of taxes, there is so much to be open for interpretation. Yes. And it's basically, if you've got a good argument for it, then maybe there are 8 different ways to do this. Yes. And the auditor leaves every time saying, nope, you're good. And you could do it 8 different ways.
Yeah, you're exactly right. Yeah.
So that was something I had never thought of, honestly.
I know. Well, and I think I knew this in theory, but this has really brought it home for me. Yeah. Like in a tangible way. So that's why it's fascinated me. So it's been a great experiment that I will continue. Who knows? Yes. I might have 20 or 30 of these. But I think I need to switch up the question, right? And then we can do another one of these. Okay, yes. Okay, Kris, I have a new question. Yeah. And here's all the possible solutions I've gotten.
I think this is your new homework every month, every couple months. Find that question that is going to confuse the CPAs.
Yes, exactly.
Go to the meetings and just kind of drop it in there and watch the chaos. Watch the chaos ensue.
Exactly. And what's interesting is I started a networking group just for bookkeepers. And so I brought this question in. I brought a list of questions and I didn't put it on the list. I kind of threw it in as a bonus question at the end. And so it was really interesting, even amongst the bookkeepers. None of us are CPAs, but it was really interesting even amongst that group that we had some good discussion and debate about it. Yeah. So I have found it to be very fascinating to see all the different points of view that you could have on one question.
Well, I do want to say, the reason that we're even bringing up this topic goes to show the kind of intentionality and effort that Lindsay puts into these kind of things.
Thank you.
And that is something I can tell you from what I've seen with Lindsay. And if you've been listening to this podcast, you know that this is not a one-off thing. This is something that you get. She puts this kind of work in to your books if you come to Sakline. And so that's one thing I love about you, Lindsay, is it's not this is interesting, but it sounds like too much work, so I'll leave it. It's like, Man, I have got to know more about this, and I am going to get to the bottom of this if it's going to take me all week, but I'm going to do it. So that's one thing that I love about you, Lindsay.
Thank you. I appreciate that. Yes, I've always been very curious. I'm like the equivalent of the toddler that's always asking, why? That's me, right? I got to dig in on something like this. It's like, oh, this is too good. I've got to figure this out, right? So thank you. I appreciate that. That's very kind. I actually wrote a blog on this too. So if you go to our website, sakline.com, I have a blog written about my experience asking different CPAs this question. So this is how much it's fascinated me.
Check it out. And that's not the only blog there. You've got plenty of other blog articles to read through. You can also find more podcast episodes on the website as well. So we know about Sakline.com. How else can people reach you, Lindsay?
So I am at info@sakline.com if you want to email me, or phone number in Dallas is 214-396-5020. We also have a San Antonio number that I have not memorized yet. I'll have to pull that up. But if you go on our website, we have our San Antonio office information on there too now.
Yeah,
so.
And we're going to put all that information in the show notes as well. And I wanted to mention this earlier. Congratulations on the San Antonio office.
Thank you. I know. I'm excited.
That's awesome.
Yes, I have a new staff accountant down there. She is amazing. Love her. Gotten her set up, and she's starting to network down there. So I'm looking forward to having some San Antonio clientele.
You know, I think the next client office is probably going to be in Las Vegas, if I had to guess. That's probably where the next one's going to be, just so she can make the business trips.
Well, okay, so I actually am going there in 2 weeks. And guess what it is that I'm going for?
Is it a business trip?
It's a CPA conference.
Oh, all right.
So think how many other more solutions I can get to this problem asking around.
We talked about this on a podcast 2-3 weeks ago, and you asked me, what do you think a room full of 400 CPAs is like?
Well, no, bookkeepers. Because that was a bookkeeper convention.
Bookkeepers.
Yes.
And I am just fascinated by all of these business professionals getting into a room and discussing stuff like this.
Yes. So it should be interesting. So I had the bookkeepers gone wild. Now it'll be the CPAs gone wild.
You've got to just plant this and watch the wildfire spread.
I think so too.
Yeah.
Like this is great leading up to this conference. I don't know how many people are going to be there, but it's a big one. So this will be good. I'm excited. So the other producer gave me the phone number for the San Antonio office, 210-510-4129, if you'd like to call our San Antonio office. So, and then how can people find you?
Yes, we are online, FriedoNation.live, or you can reach me, Kris, at FriedoNation.live. It's KRIS at FriedoNation.live.
Awesome. Thank you for joining us, everyone. Hopefully you found this to be as interesting as I did. And until next time, we'll see you again. Have a great day, everyone.
By the Books is presented by Sakline. Honest, accurate bookkeeping performed on time. For more information on Sakline services or to get a hold of Lindsay, visit sakline.com or email info@sakline.com.
The information provided on this website and podcast does not and is not intended to constitute legal advice. Instead, all information, content, and materials available are for general information purposes only. Information provided by Sakline may not constitute the most up-to-date legal or other information. Listeners should contact their attorney to obtain advice with respect to any particular legal matter and should refrain from acting on the basis of this information without first seeking legal advice from counsel in the relevant jurisdiction. Only your individual attorney can provide assurances that the information contained herein and your interpretation of it is applicable or appropriate to your particular situation.